Now, what do I mean when I say traditional investing? And to keep things really simple for the sake of this video, we're gonna focus on 4 different investment vehicles. The first is shares, and think of buying shares as basically buying a tiny piece of any publicly traded company. The second is index funds. Now, index funds and ETFs are very similar. Think of them like sort of a basket of a lot of different companies. So when you invest in one index fund or one ETF, you basically invest a little bit in all of those basket of companies. For example, when you buy SPY, one of the most common ETFs in the US, you're basically buying a little bit of the top 500 biggest companies in the US, known as the S&P 500. And the percentage you buy of each company depends on their market cap and their weighting inside of the S&P 500. But you can also have ETFs and index funds for different sectors like silicone or green tech. Now, the third type of investing we're going to talk about here is bonds. And there's really 2 types of bonds, government and corporate bonds. Now, bonds are essentially a form of debt where you, as the purchaser of the debt, gets a certain percentage interest on the bond, known as a coupon. To make things even simpler, with government and company bonds, you're basically giving them money, they're giving you a percentage of interest, and then at the end of that term, they're also giving you your amount back, your full amount back. So basically, it's like a loan to a company or government, to make things really, really simple. And the last is crypto. And I'm sure you are all familiar with crypto, but if you're not, you can just think of it as another asset class that's more risky and less regulated. Now, why should you not focus on those if you only have $1,000? Because even if you invest in the S&P 500 and make 10% per year, that's only $100. Or let's say things go crazy and you even make 40% on Amazon stock in a single year. Well, that's still only $400 in a full year. When you have so little money, you need to focus on asset classes with a higher ROI, because you are simply not at the point at which it makes sense for you to have your money work for you.